Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, China's £45 billion UK tech acquisition spree gave it access to military-grade IP, triggering a national security overhaul. We'll explore how this state-backed IP transfer playbook bypassed regulations and what it means for Western tech protectionism. Second, Samsung's 60% price hike on memory chips signals a supply crisis as our demand for HBM throttles consumer electronics. Today, we'll take a closer look at the HBM production bottleneck and its implications for the entire electronics and automotive supply chain. Third, Bitcoin mining's massive waste heat is being repurposed for home heating, but critics question its efficiency and e-waste impact. This discussion will reveal how this trend could impact home energy use and grid stability and what it means for the future of distributed computing. Fourth, the bull market's three pillars are cracking as Big Short legend Michael Burry flags creative GPU accounting in the AI sector. We'll analyse why these accounting concerns are a turning point for AI valuations and how they could affect investment strategies on Wall Street. Fifth, iconic American brand Jeep ranks dead last in quality as sales plummet 40%, forcing a risky comeback amid EV recalls. In this episode, we'll break down the brand's strategic missteps and what they signal for legacy automakers navigating the EV transition. A new investigation reveals China spent £45 billion on UK businesses, and in return, it got access to military-grade technology. This spending spree was at its height following a 2015 Chinese state directive called Made in China 2025. Now, this context is crucial because Made in China 2025 isn't just a slogan. It's a detailed, long-term, state-driven plan. The goal was to make China a world leader in 10 key sectors, especially semiconductors, aiming for 70% self-sufficiency. When we place this alongside recent Western policies like the US CHIPS Act or the EU CHIPS Act, the contradiction becomes clear. The West moves are seen by many as reactive, a response to recent shocks, not a decade-long strategic vision. According to US-based research group Aid Data, the UK was the top destination for these investments among all G7 nations. Here's how it worked. Take the case of Imagination Technologies, a British firm specialising in semiconductor design. In 2017, it was bought for £550 million by a private equity firm named Canyon Bridge. That fund's single investor was backed by China Reform, an organisation that reports to China's State Council. What's often missed is the subtlety of the playbook here. This is a classic example of what experts call the passive investor strategy. A state-backed entity uses a private equity fund to acquire a stake, often presenting itself as a silent partner. This structure can be incredibly complex, making it difficult for regulators to trace the money and intent. And what made this so brazen was that in that same year, 2017, the United States actually blocked this very same fund, Canyon Bridge, from buying a US semiconductor company. The US had a robust review process, but at the time, the UK simply didn't have a comparable mechanism. The former CEO of Imagination, Ron Black, says he was initially told the Chinese backer would be a passive investor. But that changed in a meeting in Beijing. Black says he was asked to oversee the wholesale transfer of Imagination's technology to China. He recalls the representative saying specifically, from the heads of the British engineers to the Chinese engineers, then lay off the British engineers and you'll make a lot of money. Black refused. He says he was later fired. After he left, Imagination's homegrown technology was transferred to China. The fallout for Imagination was severe. Shortly before the acquisition, their biggest client, Apple, announced it would stop using their technology, causing the company's stock to plummet by 70%. After the takeover and the alleged IP transfer, the company went through major layoffs. It's a cautionary tale about what can happen when a company's core intellectual property is the real prize. Experts warn that the algorithms behind this tech, though developed for commercial products, could potentially be used in military applications like missiles and drones. The significance here goes beyond physical hardware. We're not just talking about something you can track in a shipping container. We're talking about dual-use intellectual property. The algorithms and designs are essentially just complex code and human expertise. Because it's just information, it can be transferred digitally across the globe in an instant, making it incredibly difficult for governments to control. That's why the US has put in place sweeping export controls, not just on chips, but on the software and even the ability of US persons to support certain chip development in China. They're trying to regulate the transfer of knowledge itself. This all happened during what was hailed as a golden era in China-UK relations. But looking back, the former head of GCHQ, Sir Jeremy Fleming, delivered a stark verdict. The UK has been far too free in allowing access to strategically important industries. This entire episode served as a wake-up call, leading the UK to enact the National Security and Investment Act in 2022. This legislation gives the government much stronger powers to scrutinise and even block foreign takeovers on national security grounds. It's a sign that the golden era of open access is definitively over. Speaking of the strategic layers of technology, a while back we broke down the AI value stack hardware, cloud and applications. The latest twist arrives from the memory layer. Let's start with a single statistic that might just change your entire perspective on this company. Samsung just quietly raised prices on select memory chips by as much as 60% compared to September. The reason is the one technology everyone is talking about, artificial intelligence. The AI build-out is, in the words of one analyst, absolutely eating up a lot of the available chip supply. As we've discussed, NVIDIA controls over 80% of the chips needed for AI training, but those accelerators are increasingly gated by one thing, memory bandwidth. So the thing is, the chips we're talking about aren't the normal memory you find in your laptop. They're a special high-performance type called high bandwidth memory, or HBM. Think of regular memory as a single-lane country road. HBM, on the other hand, is like a massive multi-lane superhighway built right next to the processor, allowing the enormous amounts of data needed for AI to move at incredible speeds. This is why AI companies are desperate for it, and it's creating a fundamental split in the entire chip industry. This creates a fundamental conflict. Chip makers like SK Hynix and Micron are chasing massive demand for the advanced, high-profit HBM chips that power AI servers. They're prioritizing those lucrative contracts because AI companies are willing to pay top dollar. Now, shifting a factory from making standard memory to this special HBM is a colossal undertaking. It's not just a simple retooling. Research shows it's a multi-billion-dollar bet. The production cycle is up to 2 months longer, and the manufacturing process is so complex that the yield of usable chips can be 20 to 30% lower. So when these companies pivot to HBM, they are effectively cannibalizing their ability to produce the cheaper chips the rest of the world runs on. But that decision is creating a massive supply squeeze for everyone else. One expert put it bluntly, saying it could be very bad for PCs, laptops, consumer electronics, and automotive, which depend on cheap memory chips. What we're seeing is a classic example of something called the bullwhip effect in the supply chain. The intense demand for one specific component, HBM, is causing panic. Downstream manufacturers, fearing they won't get the memory they need, start placing frantic, inflated orders. This false signal ripples backward, causing shortages and price spikes for even unrelated, less advanced chips. And the rabbit hole goes deeper. The memory industry is still reeling from a recent downturn, which led to major underinvestment. They're trying to build new capacity now, but that will take time. The fallout is already spreading. The co-CEO of China's largest chip maker, SMIC, just said customers are hesitant to even place orders because they simply don't know how many phones or cars the industry can supply next year. While China is feeling the pinch first, analysts caution this is a global problem. For China, this memory shortage creates a new strategic vulnerability, and it's indirectly connected to US sanctions. The sanctions are already restricting their access to the most advanced AI chips. Now, the global gold rush for HBM is squeezing the supply of the conventional memory chips that China's massive consumer electronics factories depend on. It's a double whammy. As a result, a new report from TrendForce predicts the memory industry has now begun a robust upward pricing cycle. And this isn't a short-term blip. Analysts project these elevated prices will likely continue into at least the first half of 2026. For investors, that means memory vendors may enjoy pricing power for a while consumer tech and even autos grapple with higher costs. We were just talking about the massive energy and capital demands of the chip industry. Now, let's shift our focus to an unexpected byproduct. Heat. Believe it or not, the Bitcoin mining industry generates so much waste heat, it could warm up an entire country. According to one report, the global network produces about 100 terawatt hours of heat annually, enough to heat all of Finland. Now, it's worth clarifying that Finland comparison, in places like Finland and Sweden, they are already capturing waste heat, but they're doing it through massive centralized data centers that plug directly into citywide district heating systems. It's a highly coordinated, large-scale engineering project, very different from the decentralized home-by-home model we're about to discuss. So entrepreneurs are racing to capture that energy. The idea is to turn a massive energy waste problem into a solution for winter heating bills. As one CEO puts it, you could be paying the same price as heating the house, but the perk is that you are mining Bitcoin. It's a clever use of what would otherwise be vented into the air. But the concept has plenty of skeptics. One business school professor calls it false hope, arguing that for the average person, it's just an inefficient way to heat a house. The professor is touching on a key technical point, the coefficient of performance, or COP. A Bitcoin miner, like a simple space heater, is nearly 100% efficient at turning electricity into heat, giving it a COP of 1. To put that in perspective, a modern heat pump can have a COP between 2 and 6. This means for every 1 unit of electricity it uses, it moves 2 to 6 units of heat into your home. So while the miner pays you back in Bitcoin, a heat pump is dramatically more efficient at the primary job of heating. He states that home computers have almost zero chance of successfully mining Bitcoin anymore, and that these devices are little more than simple space heaters using your own electricity. And the environmental cost goes beyond just electricity. Bitcoin mining hardware becomes obsolete very quickly, often within just 2 to 4 years. This creates a massive electronic waste problem, an estimated 30,000 metric tons of e-waste every single year. So you have to wonder, are we just creating a new category of disposable e-waste disguised as a sustainable heater? And yet the crypto-heated future may already be unfolding in Chalice, Idaho. A company called Softwarm is installing Bitcoin rigs in local businesses to offset heating costs. One car wash owner was spending $25 a day just to melt snow. Now, they say the miners produce more money in Bitcoin than they cost to run. This is where the situation takes a more complex turn, raising a huge question. What happens if this scales up? If thousands of homes in a single neighborhood all at a constant high energy load, it could cause serious grid stability problems. But here's a fascinating duality. Because miners can be turned on and off so quickly, they are perfectly suited for demand response programs. One large mining company in Texas actually earned millions by shutting down during a heat wave, sending power back to the grid. So these devices could either strain the grid or bizarrely help stabilize it. The founder of Softwarm, Cade Peterson, has heated his own home this way for years and makes a bold prediction. You will go to Home Depot in a few years and buy a water heater with a data port on it, and your water will be heated with Bitcoin. But that's not the whole picture. The story might be even bigger than just Bitcoin. The heat is a byproduct of any intense computation. So what if that computation wasn't just solving puzzles for cryptocurrency, but was instead folding proteins for medical research or training an AI model to fight climate change? The future might not just be about heating your home with money, but heating it with progress. That future of distributed computing is exactly what Wall Street has been betting trillions on. But now it seems the 3 pillars holding up this bull market are all starting to crack at once. The core beliefs that have fueled market euphoria are now under intense scrutiny. First, the relentless AI build-out. Second, the consensus that the Fed would keep cutting rates. And third, the expectation of a clean policy year in 2026 is looking less certain. Policy and trade flare-ups were always a risk, and we've already flagged the drug pricing move slated for mid-2026. If you look under the hood of that AI build-out, you'll find the massive spending on data centers is being financed by staggering amounts of debt. Companies are taking out huge loans, betting that future AI profits will be big enough to pay it all back. For example, Meta recently entered a financing deal worth over $20 billion for just one data center. This has uncomfortable echoes of the fiber optic overbuild during the dot-com bubble, where companies laid miles of cable on borrowed money, assuming infinite demand. And the risk is that if the AI gold rush doesn't pay off, we could see a similar cascade of defaults. Once stocks start to wobble, the big names get noticed. After Nvidia failed twice to break the $200 price level, suddenly Big Short legend Michael Burry's warnings about GPU accounting started to gain traction. Burry is drilling into one concrete lever. And to understand the risk, you need to understand the accounting methods he's flagging. Essentially, he alleges that some tech companies are stretching out the depreciation schedules for their GPUs. Normally, a GPU is written off over 2 or 3 years, but by extending that to 6 years, a company can slash its annual expenses on paper, making its earnings look much bigger than they actually are. Burry estimates some firms could be overstating earnings by more than 20%. The implication, if he's right, is that some of the incredible profit numbers we're seeing are a mirage, and the numbers don't lie. The NASDAQ 100's valuation just burst through a key 3-year cap, a potential sign of overheating. At the same time, Bitcoin is in a disorderly breakdown, bleeding nearly 25% of its value in just 5 weeks. This is what that snapback we warned about looks like. But if you want to see just how chaotic the thinking is on Wall Street, look no further than hedge fund Coatue Management. Just last June, its founder left Alphabet off a list of the top tech companies of 2030. Now, in a stunning reversal, the fund has just more than tripled its stake in the company. This desperate scramble for position shows just how quick shifting the sands have become. And it's not just one fund. This kind of whiplash is happening across the hedge fund industry. One quarter, they are piling into AI stocks at a record pace, and the next, they are dumping them. This volatility from the so-called smart money shows that even the most sophisticated investors are struggling to predict the long-term winners. While corporate earnings are holding up for now, the market is walking a messaging tightrope on Fed policy. The recent dips have been shallow, but they are incomplete pullbacks. This failure to create a cleansing flush could be compounding the risk, setting the stage for a much tougher setback ahead. While the tech giants are grappling with volatile valuations, some legacy players are facing a much more fundamental crisis. The most unexpected news in the auto world today has to be this. Out of 32 major car brands, the iconic American brand Jeep was just ranked dead last in overall quality by Consumer Reports. This comes after 6 consecutive years of declining sales, with the brand's numbers cratering an astonishing 40% since their 2018 peak. Their US market share has crumbled from over 5% down to just 3.7%. Now, in a stunningly direct admission, Jeep's CEO just went on the record saying, quote, "We confused our buyers. We confused our dealers. I'm here to tell you we got the message. We're fixing it." When he says they confused our buyers, he's pointing to a massive bet on going up market, trying to turn the Wagoneer name into its own luxury sub-brand. The problem is, this strategy alienated their loyal base while failing to attract luxury buyers. The fix is an all-out comeback attempt. They've realigned prices after a failed strategy that saw models like the Grand Wagoneer top 100, $11,000. That pricing decision put them in direct competition with the Cadillac Escalade, and the numbers show the result was a disaster. At one point, Grand Wagoneers were sitting on dealer lots for an average of 313 days. That's almost a year. It's a classic example of a brand misunderstanding its own identity. They're unleashing a blitz of new vehicles and have even hired LL Cool J for a massive marketing campaign with the theme "Don't Call It a Comeback." The CEO is on a mission to, in his words, grow, grow, and grow. However, if you zoom out, you'll see another layer of strategy at play that complicates his comeback. Just as Jeep is betting its future on a new all-electric SUV called the Recon, the company announced a recall of over 320,000 of its plug-in hybrid models due to a risk of fire. This recall is a huge blow to consumer trust precisely when they need it most, creating what experts call a major trust deficit. The recall affects Jeep Wrangler and Grand Cherokee plug-in hybrids, with research pointing to defects in the high-voltage batteries. When you're trying to convince people to trust you with a brand new all-electric vehicle, having your current electric hybrid models recalled for fire risk is a nightmare scenario. This is happening at the exact moment EV demand is slowing and crucial federal incentives have ended. Now, here's where it gets interesting from a strategic standpoint. Jeep's manufacturing decisions play a huge role here. The new electric Recon is being built in Mexico. Under the rules of the Inflation Reduction Act, or IRA, that decision could disqualify the vehicle from thousands of dollars in US consumer tax credits. So while competitors like Ford and GM are investing billions in US factories to secure those credits, Jeep's strategy may leave their flagship EV at a significant price disadvantage right out of the gate. Despite the comeback plan, the numbers on the ground reveal the true scale of the challenge. The industry average for unsold cars on dealer lots is 88 days. Jeep's current inventory level is a staggering 146 days, one of the highest of any major brand.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.